Hello traders, welcome to FreeFX. My name is Francesco Sani and today is the 21st of April 2016. The trading video for today, following the disclaimer here, is going to talk about a particular topic which was suggested to me by forum member Dorank from babypips.com. So thank you, Dorank, for suggesting this topic from the forums, and I'd like to really introduce the topic, which is trading, politics, and natural disasters. So on today's video, I'm trying to talk about the influence of different, as you can see there, different phenomena that may not actually be from finance itself. Let's start, therefore, with the first one I'd like to talk about, which is the S&P 500. Now, there are two ways around this. One is to take a chart and find a reasonable correction or movement within price, and try to really see if there's a particular reason why that is. And you can go through economic calendars back in time. Some of them don't really stretch back, so you find that you'll struggle if you go through normal providers like investing.com or DailyFX. They may not go back, so you have to then go into Google and search for a particular date and try to find perhaps you're not going to find perhaps a handy guide. So you'll have to sort of look a little bit more yourself and be a little bit more savvy about how to get the news and be more precise. So normally you get your daily economic data list with different currencies. The further back in time you go, those data may not be available, so you have to specify exactly. So you might go either on a chart and see a particular move, and then decide, okay, this is the S&P 500, so maybe I can look for, this is the US equities index, so maybe I look at US news from this particular time. So you start obviously with the country itself, whose assets are denominated, in which currency are denominated. So for the S&P, it will be the US dollar, the United States, etc. So that's not always as easy as that, because obviously there are global phenomena which affect various asset classes. So it's not really as simple as that. So that's one approach, to take the chart, and the other approach is to take a piece of news and then go through different asset classes, equities, commodities, currencies, and see within those what the effect was of that particular piece of news. So, for example, let's start the conversation from here. I'm going to do it this way around. We're going to do it with the chart in front of us, but actually in this case, knowing what we're looking for already. So actually it's more the other way around, is taking a piece of news. The piece of news in this case is the 11th of September 2001 Twin Tower attacks, the terrorist attacks on the United States capital. So we are looking at this particular chart because this is the Standard & Poor 500, and it represents sentiment in a big way for US equities and further afield. I've circled the area in red. You see the candle here for September 2001. This is the monthly chart, okay? So what we're going to do now is, taking a look at this, I'm going to zoom in a little bit more so you can see, okay. And then I'm going to stretch a little bit so you can see it's quite a big candle. And then if you're not sure about equities pips, we're going to just measure it. So this is for high to low, okay, and it's about 2050 pips. And if you don't want to do that, just click on the actual candle and you can see high to low, okay? So yeah, it's about 2000 and more pips. Now, obviously then there was a retracement, and then we can get into analyzing movement before and after, and see the impact that had within that year and into the following year, 2002. Okay, certainly the effect was a continuation of that into 2002. The final months of the year actually cancelling out that bearish effect. So then we can start, looking at the impact on price within the time period, within the month, for example, and then seeing what effect this had on the actual year or in the months ahead or behind. So in this case, we can see that there was an actual price move that we can see even better if we went to the daily chart. So let's go to the daily chart. And then if we scroll back to 2001, again, unfortunately, we have to do it again every time we come out of that. So 2001 is a little bit further ahead. Excuse me. Here we go. Okay. So the 11th of September, and I apologize if at any point any of you might feel slightly taken aback by my slightly cool tone when talking about things that really have affected a lot of people. And I haven't personally been affected by any of these events, so I've not had a personal loss I didn't know anybody in these events, so obviously that adds or an easier challenge for me than if I were emotionally affected by these events. But I'm really in that way I'm fortunate, but obviously so many haven't been, and it's always worth remembering that these events affect not just economics or price on a chart, they affect real people, and the sentiment, meaning the mood on the street. So obviously that translates into many things. People may for a while stop going out, buying luxury goods or buying the things that they wanted to buy before. They might feel that it's a time for grieving, and you can look at all sorts of repercussions, not just on a particular asset. You can look at real economic impact. But just because of the scope of this discussion here, the video is going to just look at price charts mainly. So excuse me if I just plow on and really look at this chart only. Now, here's what happens in the S&P 500 on a daily chart. Okay, so the 11th of September is there. This is the 11th of September. Okay, and there's a big gap down, as you can see. And then the okay, that's the 11th of September, and then there's a big gap, in fact, of 7 days. And we can certainly go into more detail. If you go to Investopedia, there is an article here which talks about how the 11th of September attacks inflicted some losses on the US markets, and it says that it was the longest shutdown since 1933. It talks also about who benefited from this drop in price, because insurance had to be purchased in financial terms. So obviously there was some losers and some winners. It also says that the aftermath was that no more than 1 month had elapsed that the Nasdaq and the S&P had regained its pre-11th of September price levels. And there is obviously, a lot to say about whether it was this particular event that brought the US equities down on that day, or whether you can start looking at the price and where it was. Okay, so if you sort of stretch back, see that we'd reached a point here which was perhaps on a downtrend already. That was 2001. Okay, through the beginning of the year, and then bounced back in April, and then making lows. So this drop here, which took price all the way back to this area around here in 98, and then bounced back, could be said to be something that was more of a natural part of a natural downtrend, coming down to a level which for some reason was supported, if you like, and then it bounced again, and then new lows 2002 and so on. So there are different interpretations of this, but certainly there was an effect on the day, and this is one particular example where there is a real effect of a news event on the day. So, if you were thinking, for example, let's take a technical view. Okay, so some of you don't really espouse, don't really espouse the technical analysis view and think that charts don't. This is not how banks operate. This is not how big investors operate. So we could talk numbers then. Let's ignore chart and pretty patterns, if you like. Let's talk price then. Okay, so price in April 2001 was at 1,100 for the S&P 500. Okay, so obviously, you buy at 1,100. It's a double zero. That's a round number. And you buy and you profit up to 200 points. Fair enough. So you're a short-term investor. Your system, your robots, your EA, your expert advisor, your algorithm kicks in, follows this up to somewhere around that, and then it closes out just below that as price retreats. Okay, and then maybe it kicks in on a sell and you're profiting, and maybe you think that this time round we have the same situation and reaching 1,100, perhaps expecting another bounce or not. So at this point, you notice that the 1,100 price comes into play again, and price then gaps below it and continues down all the way to nearly 950. So that's that's a fair gap, 150. So I'm just wondering, at this point, what any of us would have done the day before the September attacks, because we were getting back down to this level. Now, if you're a buyer, you could probably say that you're getting ready to get in again, and then when that broke down again, that would have maybe said, oh, it's not time to get in, so waited. And look what happened. Price retraced, and then within yes, so in November we were sort of back above it again, but only briefly, because then it sort of went a bit sideways here. Now, this is a really short example for this particular event, so let's go to another one then. Okay, so let's go to another example. This time we will start from the actual event description. This is the Tohoku 2011 Japanese earthquake and the tsunami. And this was a catastrophic event, as we all remember the scenes of devastation. And you can see here that there were nearly 16,000 deaths. Obviously, depending on the sources, that may vary. Thousands of injured, missing people, and thousands of buildings that totally collapsed, and many more that were in a great state of disrepair. This is what we're looking for: events of a magnitude that have or the potential to impact the sometimes ivory tower of financial assets that seem to be very choosy about which events it pays attention to and which ones it completely ignores. Okay, you may find sometimes we've seen in terrorist attacks in the last few years, including the ones in Paris last year, that you may find that there are reactions from the markets. By the markets, I mean, some sort of asset class that reflects the market, which could be something like the S&P 500 or other equities, or the euro dollar, or something that has enough reach that is in tune with general sentiment. So we're not talking about an obscure stock or an individual currency necessarily. We're looking for something that has a wide range of investment within it that really does suffer from phenomena of global impact. This certainly had the magnitude to impact things worldwide. So let's see what happened on the day. The day was the 11th of March 2011. Okay. So then we go to the first choice here would be let's go to the Nikkei 225. So this is the Japanese equivalent of the S&P 500. So we have the earthquake here, and the 11th of March 2011 was a Friday. Okay, so usually Fridays can be quiet days on markets, but obviously, if you're dealing with non-farm payrolls or other things, it may not be a quiet day, but sometimes it is. So 11th of March 2011. So let's go and see what happened on the 11th of March 2011. So this is the monthly chart. Okay, so just to give you the wider picture, from 2011, we were at pretty much historic lows in 2011. And you can see from this baseline, 7,500 was in 2003, and in 2008, 2009 was sort of the bottom line. Okay, so we were in this context. Okay, so let's kind of zoom in and see. This is the candle for 2011, the month of March. And so the high was up there. And if you want to measure it with a ruler, just give you a quick pip count. The candle for the month was 2,350 more or less, which is not too dissimilar from the month of September 2001 in the United States. So a similar sort of movement on the month. But like in the United States, there was some retracement of that. And then we can actually zoom in a little bit more, go to the daily. Okay, so we want 2011. Unfortunately, this actually moves back to the start. So let's go back to 2011. Okay, so here it is. 11. There it is. Okay, so we're looking for the the 10th of March. Okay, so the 10th of March, there it is. We have a sharp drop. And then as the news unfolded, we have that. Then the weekend close, and then back on the Monday, and further drop. Okay, in fact, that was the biggest candle. And then the Tuesday, big candle, but long retracement. From that bottom price that we said, which was 7,500, so we're getting kind of closer to that price area, if you like, which was a historic low. So we didn't really go any further than that, but that was quite a sharp drop. So that was a Tuesday. The Wednesday, and then notice what happened after that. Retraced about half of that, even more than that. And so by July, we've gone back almost all the way up. Okay. Then there was a further decline, etc. Now, let's see, for example, just for the sake of argument, that you saw this as a big decline, and you measured it, and it was from here to here. That's the actual close, because then there's a big wick there. So, and that's about 1,500 pips. Okay, so you then started looking around. So this is 500, 1,500. Okay, that's about the same. But what happened here? This was 2012. You can go and look for news that happened in 2012. We're looking for natural disasters here. So we looked at a terrorist attack before for America. Here for Japan, we're looking for a natural disaster. Now, natural disasters are not subject to conspiracy theory because there is nobody behind that. You cannot engineer a tsunami wave just like that. Terrorist attacks, uh, you know, there are different theories about what happened on 11th of September in America. But here is sheer nature at its worst. So if we look for other earthquakes in Japan, you'll see that the Fukushima plant on the 11th of April. So we had the March tsunami and then the Fukushima earthquake aftershock in April. So 11th of April, here we go. So 11th of April would be about there. So let's go back and see the 11th of April. That's 11th of April there. Okay, not much happened there. So the big shock had been spent, if you like. So the shock factor had been absorbed by the markets by this point. And if we went further down, okay, now there's a 10th of July 2011, and we can check that one out certainly. Okay, 10th of July is here. Now this gave us a bit more of a move, about 250, about 500 pips, and then retraced. What happened at the end of July to give us this move, beginning of August? See if there's any natural disaster here. Okay, there's nothing listed here in Japan, so maybe something else happened around that time. Okay. Now the other thing we need to look for is political elections, and this is another area which is quite interesting. So for that, I'm going to go to the US dollar. I hope you might not sort of think that this is a US centered video. I'm using the US dollar because I think the world is familiar with it. It's quite an easy focus for all eyes. So whether you're in emerging countries, Europe, indeed America, and Australia, etc., everybody hears what happens in America because it makes big news. Everybody heard about the Japanese earthquake, of course, but when it comes to politics, I think the political elections in America tend to be big news because of the size and the impact it can have globally, even more than China, surprisingly. But that may change. But certainly for now, I'd say we'll just concentrate on the US elections. Because they're happening now, we're aware of who's running for presidency and especially now. But we're going to look back actually because currently there's a lot of talk about the Federal Reserve Bank and that sort of mires the US dollar into uncertainty. So I want to go back before the sort of tightening and the rate hike, much before actually. I want to go back to 2012. Why? Because in here are the different elections, and in 2012 we had so this website, by the way, is 2702win, TOWIN.com, and it shows you all the presidential elections for the United States. This with interactive maps, different votes in different states. So this tells us that the elections in 2012 were held on the 6th of November 2012. So the 6th of November 2012 gave us a Tuesday. So the thing to look for here is the surprise factor and whether there was enough surprise to shock the markets in some way. Not that US presidential elections have a direct impact on the markets, or do they? Let's find out. So Obama won. Here's how far he went. 65 million votes, 65.5 million votes, and Romney had 60.5 million votes. So you would say that 5 million votes are a big difference. But if you read further, it says that the projections were saying that the race was too close to predict a winner in advance. So, the polls obviously were churning this out, and but then, there was a clear winner. And the cleaner was the 7th of November. It was declared Romney conceded the election to Obama. Okay, and all the votes have been projected by the 10th of November. So between the 7th and the 10th of November, we're looking for sort of that period. So let's go to the charts then. This is the US dollar, which is a weighted index, all different majors distilled into one index just for the dollar. So we could look at Euro USD, for example, because it has the most impact as a pair on this index. But let's just look at the US dollar. I'm using Market Scope 2.0 on FXCM trading station desktop. So this is the FXCM Dow Jones US dollar index. So you see it doesn't go up to the same number. It's a slightly different numbering if you're used to the quote-unquote official US dollar index. But anyway, so this is the 2012 election, and we're looking for the 7th of November. So let's go straight into the detail here, and then we'll look at the wider picture. So I put a little circle here, and this is the actual date. So that's the 7th of November there. Okay, this tiny little candle, truly small. And if you think it's a matter of scale, I'm going to measure it for you. Okay, so low to high, this measured, I'm trying to see, about 50 pips, and it was more pretty much a doji here. It's all wick, so not really much movement there. Now, what does that tell us? We're in November. It's not necessarily a quiet month, November, historically, and we are. It's a weekday. The markets are functioning normally, as far as I know. And so what this tells us is that nobody was really moving much on the day in terms of buying and selling in dollars or through dollars, or actually on this index, because of the indecision, sort of waiting for the results. That's the 7th, then the 8th, the 9th, and by the 10th, as we said, all the results have been counted. Then it was a weekend, so the Monday 12th, we opened again. Very small bearish candle, but not much going on there. So until the actual 14th, we didn't see much going on, and then we had a lift off. Okay, lift off, and then back to the same levels as sort of election results day. And then in December, which is kind of quiet month, or can be, towards the end of December, we get into Christmas, and we see the quote-unquote Santa rally. Okay, so let's put it into a monthly and see. Okay, going back to 2012, I put a circle around that. Okay, so here's 2012, and there's your November candle. Okay, this candle here, not really big, but let's take the circle off. Circle here, if it will allow me to take it off. Remove. Okay, so let's try to see the bigger picture here. And okay, we have big movements here. This is the great financial crisis, big rise, big fall, and further fall. So in November 2012, we were here. In November 2011, we were a little bit lower, but not much. What was happening in terms of price action? Let's put an indicator here, just to kind of give you a quick idea of the sort of trading range. Okay, so we're looking at 2012 November, which is here. Okay, so trading range starts getting kind of a little bit smaller here, and compared to November 2011, it's quite a lot smaller actually, from 430 to 310 average pips. Okay, that's quite a lot smaller. The other thing you might see as well is that if you trade using patterns or technical, if you want to call it that, I'm just going to draw something here. Just forgive my bad skills. Just give you a little bit of a... Okay. So we'll do one there and maybe one there. Okay. So what we see here is a sort of wedge forming. Okay, so lows get higher and highs get lower, and then a breakout. Okay, now remember this is the monthly chart. Okay, so we are looking at things in a slightly compressed way. Okay, it's a monthly chart, but still it's a breakout nonetheless, and certainly then the next breakout, you can see another wedge here and another breakout. So, you know, if you look at it that way, then it's just a case of saying, well, you know, this is November 2012, and then the breakout, and then another breakout here. So the impact is quite hard to judge because you have a technical level or a technical setup here, which is sort of screaming breakout. How much did the presidential election influence this breakout? Well, that's for you to decide. And it's all very well in hindsight saying, oh yeah, but obviously, so, you know, if this is what happened then when we know the results in November of this year of the presidential elections, then, you know, we'll have, you know, in the dollar, we'll have some kind of breakout to the upside or the downside, depending on who wins. You know, if Trump wins, the dollar is going to fall. If Clinton wins, then the dollar is going to rise. You know, something big is going to happen. Well, we don't know that because even if you did this exercise through all the different elections, which we could actually go into now, if I just went back and looked at another election, the 2008 election, let's say. Okay. 2008. So who won 2008? It was indeed Barack Obama again. And let's go back further. Let's go back to another candidate, 2004. So we have George W. Bush. Okay, so George W. Bush, here we go. Okay, so and he won by not actually such a wide margin versus Kerry. So, but let's see what we can find out. So when was he actually? When did he actually win? Do we have the actual date? Okay. I imagine it'll be November again. Date might vary. The 2nd of November. Here we go. 2nd of November. So 2004. Let's go back here and find 2004. Let's keep this small so we can see this, which was Obama's re-election, just recent, and 2004 November, the re-election. Again, we're comparing re-election versus re-election of the same president. So Bush, second term in office, 2004, and this is November. You can see November here. It is this candle, 2004. And bigger candle than this one, and actually quite bearish. Okay, sort of 500 pips. And then following that, there's a pickup. So actually there isn't a wedge here. As you can see, that there isn't really a wedge. Okay, it's just doing its thing, low and then further low. So it carries on with the downtrend. And it's preceded by another sort of large-ish bearish candle. Then after the presidential election, so the following month, there's a stall at 10,500, which seems to be quite a big round number level. And then further up it goes, and then eventually, but quite a lot later, and we're talking about 3 years later and more, there's a break of that 10,500. So just to say really that the impact of a presidential election is not always decisive one way or the other. There may not be a technical pattern to break in the first place. So markets are just allowed to continue. As you can see, this is just continuing the sort of down months of October and November. You could go into more detail and say, okay, so what were the projections for who was going to win? And based on how Wall Street was feeling, based on how equities were feeling about another Bush win, that might have altered the mood. Certainly, there seems to be sometimes a disconnect between our expectations. So, in other words, when markets align, like in the Obama victory here, with a feeling of, the general mood in the nation on the streets is one of excitement and jubilation. Sometimes that aligns with what happens in the financial markets, but it's not a like-for-like straight parallel. So it depends who the winners are on Wall Street, who has the biggest clout. So it's a case of really measuring that, which is really quite a vast and inconceivably immense game of probabilities, which I wouldn't want to play because there are so many players with much more resources financially than the little people like myself and yourself probably. So really it just becomes impossible to say, for example, why in this case we had no liftoff. Yes, there was after, but here it's quite clear. The next month it started with a bull move, and here we had, next month was another bearish candle, then other small candles, almost like a wedge actually. So the optimism here is not showing, and this is a monthly chart. So we're looking at 6 months almost from the election results on, before a bullish move, which didn't really take the dollar far. Whereas this time with Obama, it really did actually carry through quite a bit. Okay. So you could say that from Obama's re-election in 2012, we've gone from 10,000 to 12,000. That's quite a big move. So whereas with George W. Bush's re-election, we went from 10,500 to 11,500, so half of that move, and then shortly after, a down move as well. So a greater actually down move. So perhaps the dollar wasn't ready to push higher at this point, regardless of who won the election. And it was this time round, and so it carried on. But then you have to start looking at other things that influence the markets, which of course are the more known factors like central bank intervention, GDP, gross domestic product, inflation figures, retail expenditure for the population, economics like growth in the employment or fall in unemployment, wage growth, hourly wages. All those factors play into this. So again, looking at a chart doesn't really give us all the answers. And the final thing I was going to say was, looking back to, for example, the Nikkei 225, if I can just find it again, and we see this was the tsunami. If I did an overlay just by using this, let's do another equities index like S&P 500 indeed. Let's do that overlay on current price. So this is the tsunami. No, it's not. It's gone back. Excuse me. 2011. It is. So 2011. Just make it bigger again. Okay. This is the daily, and this was the tsunami of 2011. Now, who influenced whom? What influenced the S&P 500 on a day? Was it the Nikkei 225, or was it something going on in America? Well, we certainly have the correlation here of a down move in the, this is the S&P 500, 1013, 1300 down to 1250. Okay, and obviously Nikkei 225 was hit harder and then recovered, but actually the S&P 500 recovered better. So then you can go into finding out, for example, 2011 was the okay, so if I put in March 2011, market crashes in the United States, and it goes quite a way back, but okay, the closest is the August 2011, and I think the flash crash, yes, it's May 2010. So actually it was the year before. So nothing going on in the US stock markets. So again, this fall in the S&P 500 then could indeed be said to be motivated by something else. Now you could make the correlation again and say, you know, post facto, going back, looking back and saying, okay, well, I can see the correlation here. But then you might say, well, how correlated are these two assets throughout the year? And then you could do a monthly chart check, okay, and sort of put them side by side historically. So that was 2011, which is here, okay, March 2011, there it is. And then sort of see that there is a correlation, because look at 2012, for example, this curve is matched in some way by the S&P 500, and this sort of choppy area here is also matched by the S&P 500 indecision, and this dip is matched. And you know, if you just amplify a little bit, you can see the dip and the peak, the dip and the peak, and this peak is lower than this peak, this peak is lower than this peak, and then another fall, and a pickup, and a little bit of a pickup. So the Nikkei 225 is doing slightly worse at the moment than the S&P 500, but both are certainly not setting new highs. So there's a strong correlation between these two assets anyway, historically. So what happened on the day here in 2011, or rather in the month of March, naturally was going to find a resonance in the S&P 500 because of this correlation already existing. But it's not to say that this correlation is going to stay the same throughout. So, you know, if we had, God forbid, if we had another flash crash in United States stocks, or if we had another tsunami or earthquake in Japan, well, we've had one actually this month, so, but seemingly it hasn't quite translated into big losses for the Nikkei 225. So this is a really big field, but I do hope that this video has sort of helped to illustrate these points, and I look forward to hearing your comments and seeing you on my next video at FreeFX. Thank you for listening.